go. You can start.
Thanks, Dion. Good day, students. Today we are dealing with property, plant and equipment. For those who don't know me yet, I'm Siyanda Freedom Ngadi. I am the module representative leader for FAC 1502. So today I'll be the one who's lecturing you on PPE. So let us just start. Currently I have electricity crisis. I might cut off at some time, but let's hope it doesn't happen. So if it does happen, I'll ask my colleagues to assist. I have two colleagues here. It's Dion Fonwell, together with Mohokone Joseph. Let me just get to the business for today. Today, what we are trying to learn here, we need to understand what is property, plant and equipment. In short, we call it PPE. Then we need to know how to determine the cost price of property, plant and equipment. And we need to know how and when to record the purchase or the acquisition of property, plant and equipment in the accounting books. We also need to be familiar with the concept of depreciation. And we're also going to look at other important concepts that you need to familiarize yourself with when you're dealing with property, plant and equipment. I'll also show you the methods of calculating the depreciation for this property, plant and equipment. I'll also show you how to record the depreciation expense in the accounting books, and I'll also show you how to deal with the disposal of property, plant and equipment. When we speak of disposal, we are talking about a point where we see that the asset is of no use to the entity anymore and we are trying to get rid of it. So that's why we talk about disposal. It's a sale of that non-current asset, which is our property, plant and equipment. I will also show you the format of property, plant and equipment note. And I will also show you how to disclose the property, plant and equipment in the statement of financial position. And the two parts that we're going to look at the end, it's the possible question that we can ask you on your assignments regarding the property, plant and equipment. And we're going to do a short, quick exercise on property, plant, equipment at the end. I hope I'm not moving too fast. I know that I tend to move very fast, but feel free to write on your Q&A so that if I'm moving too fast, my colleagues can tell me to slow down. And please use Q&A to ask any questions as we move along. They will be there to answer your questions. And those questions, if there are questions that they can't answer, they will hand them over to me at the end. Then I'll address those questions. Before we start on talking about this property, plant and equipment, I want us to also refresh in terms of our basic accounting equation. We say asset equals to owner's equity plus liabilities. The reason I want us to look a bit at a basic accounting equation is that today we are dealing with property, plant and equipment. So we are dealing with an asset. So it's very important for us to know how the assets behave. If you can see on my current slide on your left, we have assets. And here we are telling you that asset will always increase on the debit side. And asset will always decrease on the credit side. So as we are dealing with the property, plant and equipment, I think we need to keep this in our minds so that to understand that PPE, we are talking about an asset. So if we want to increase the asset, we increase it on the debit side. If we want to reduce the asset, we reduce it on the credit side. Another part that I also want us to focus on when you deal with your property and plant and equipment, which is PPE, as we are using the asset loses value. There's a concept now that comes in, which is our depreciation. Depreciation, it is an expense. So if you look into our basic accounting equation, you will know that expenses will always increase on the debit side and expenses will always decrease on the credit side. Yes, so let's move. The other ones that we have on my right hand side, we have owner's equity, we have liabilities and income. owner's equity, liabilities, income will always increase on your credit side. And they will always also decrease on your debit side. It is very important as you prepare the journal entries, you need to know this. So for me, I always say basic accounting equation, it is the basis of reasoning in accounting. So this is where you always start. When you get an accounting transaction, we start here. That's how you should formulate your responses. Let's get an understanding now. What is property, plant, and equipment? When we talk about property, plant, and equipment, which is PPE, we are talking about tangible items. So something that is tangible is something that you can see and you can touch. So here, PPE, we are referring to tangible items that are held for use in the production or supply of goods and services. So here what we are trying to clarify is the intention. The intention is not to sell that asset, but is to use it in the production or the supply of goods, or for rental to others, or for administrative purposes. And these tangible items are expected to be used for more than one financial period. So when we talk about PPE, our expectation is that we're going to use it for more than 1 year. So it's for long run purposes. So, and on the second point here, we are saying property, plant, and equipment are classified as non-current assets because, one, it is not the intention of the entity to sell the non-current asset, but to use this asset over the long term in each business operation in order to earn an income. So by this statement, we are not saying that property, plant, and equipment cannot be sold by the business if they feel like it's no longer useful for them. They can sell it. But what we are trying to clarify here is that when they bought the assets, the intention was to use it in order to support their business operations, not to sell. Number two, for a property, plant, and equipment to be classified as non-current asset, we are talking about those assets with a useful life of longer than 1 year. If I were to make a practical example here, let's assume that you buy a delivery vehicle. When you buy a delivery vehicle that you're going to use to deliver goods for your business, the expectation is that you're going to use that delivery vehicle for a long period of time, which is longer than a year. So automatically then it will qualify as a non-current asset. So key takeaway here is that PPE, it's a non-current asset. So if we were to make examples of property, plant, and equipment, we are talking about land and building. You're going to use the buildings for your business for longer than a year, which then qualifies as your property, plant, and equipment, and it is a non-current asset. We talk about machineries in your business, you're going to use it for a long period of time. We talk about equipment, vehicles, and furniture. So at least now from this slide, we get an understanding what is property, plant, and equipment. Then another important thing that we need to know now. So we have an understanding of what is property, plant, and equipment. Now we need to determine the cost price of PPE. So measurement at recognition. So when you buy that particular asset, so now we need to know what is the cost. For us to be able to record it in our books in the business, we need to know what is the cost of that property, plant, and equipment. And the cost price of the property, plant, equipment consists of, it will be the purchase price, the import duties that we have paid, the non-refundable taxes that we have paid. And remember that all these costs that we are talking about here, it after trade discount and rebate have been deducted. Because when you get your trade discount or your rebate, what you generally do, then you need to deduct those ones because you did not incur that cost at all, so that we have our correct cost price for the property, plant, and equipment. What will also form part of your property, plant, and equipment cost price? It will be your transport cost that you incur to bring that particular PPE to the location where it's going to be used. What else? What the other cost that will also feature in it will be your specialist fees. For example, if you buy property, plant and equipment that requires a specialist before it can be actually used. That cost needs to be capitalized to the cost price of the property, plant and equipment. We are also looking at the site preparation. If, let's say, for example, you're going to install a certain plant, so you need to prepare the site. That site preparation cost, it should form part of your cost price. The installation cost will also form part of your cost price. And lastly, sometimes it happens that after installing maybe a plant, you might be required to dismantle that plant and restore the site where you have located that plant once we are done maybe with that particular business or activity. So the estimated cost of dismantling or removing that property, plant and equipment and restoring the site will also form part of your cost price. It is very important to understand. So these are costs that you will incur when you are actually buying those property, plant and equipment. What we need to understand here, what will be excluded specifically from the cost price of property, plant and equipment, it's the finance cost or interest charged on loans that you have used to acquire that tangible non-current asset. For example, sometimes when you buy these let's say if you are buying a building and then you took out the mortgage bond, then the interest that you're going to pay there on that mortgage will not form part of that the cost price of that property, plant and equipment, which is your building. And what we also specifically exclude here, it is the maintenance cost. Maintenance cost should not form part of your cost price. Remember that you do maintenance so that the asset continues to operate the way it to function optimally. But again, you are not really adding any value to the asset itself. So maintenance cost will not form part of your cost price. Let's move 10. Let's continue. So initially we spoke about the measurement at recognition when we are recognizing the asset. But now let's look at the measurement after recognizing the asset. So the assets now we have recorded it in our books. Then how are we going to measure it? So in terms of IAS 16, which is the International Accounting Standard 16, it permits two models to measure items of property, plant and equipment subsequent to the initial recognition. So that subsequent is after the initial recognition. Two models. The first one, it is the cost model. So in this situation, under a cost model, we are saying property, plant and equipment is carried at cost price less the accumulated depreciation and impairment. So here we are just saying under the cost model. So you will see now a new term there, impairment. When you talk about impairment, sometimes the assets, the property, plant and equipment are actually damaged. So when they are damaged, we recognize an impairment to say this one has been damaged, so it has been impaired. Number 2, another model that is used after the initial recognition, it's a revaluation model. So here the PPE, the property, plant and equipment, will be carried at revalued amount, being its fair value at the date of revaluation less subsequent depreciation and impairment. What I want to highlight here for this session is that for the purpose of this module, we are only focused, we only deal with the cost model. So our property, plant and equipment will always be carried at cost price less accumulated depreciation and impairment. The revaluation model, we're just showing you that there are two models, but we're not going to use the revaluation model for the purpose of this module. So now I just want us to answer this basic question: how and when to record the purchase or the acquisition of property, plant and equipment in the accounting books. So two criteria are very important before you can recognize the property, plant and equipment. So here we are saying property, plant and equipment are recognized as assets of an entity when it is probable that future economic benefits associated with an asset will flow to an entity and the cost or value of an asset can be measured reliable. So if you check number 2, we've already addressed number 2 because we've looked into the cost price. We were trying to determine the cost price there, so which means we were able to measure the cost price of that asset reliable. The first one talks to probably, it says it's likely that the future economic benefit associated with an asset will flow to entity. So if you purchase a delivery van to deliver the goods to your customers, the expectation is that money will be flowing to your business because you are delivering goods to your customers, and then they will pay you. So that future economic benefit that is associated with this delivery van will be flowing into the entity. You will be making money out of that. So then once these 2 criteria are met, you are able then to record that that property, plant and equipment. So now, lastly on this statement is that we are saying the purchase of PPE, it needs to be recorded where in the applicable asset account at cost price in the general ledger. For example, if we buy a machinery, that machinery needs to be recorded in the machinery account at cost. And if it's a vehicle, it needs to be recorded at the vehicle's account at its cost price. While we are still continuing, so here what we are saying is that recording of the purchase of property, plant and equipment in the accounting books of the entity, you will do the recording when on the day the transaction took place. So if you go today and buy a machinery or a vehicle, you need to go and update your accounting books. 2 ways this can happen. So you can purchase a property, plant and equipment for cash, or you purchase it on credit. If that fixed or tangible asset was purchased for cash, you will record that transaction where? In your cash payment journal. The reason when you buy an asset for cash, the money goes out. So in our cash payment journal, we record all the money that is going out of the business. So in terms of the double entry system, so because we need to know what to debit and what to credit. So when you buy a machinery, what you're gonna do, you're gonna debit that asset, because we said asset increases on the debit side. And what are you gonna credit? You're gonna credit bank. Bank is an asset again, because the money, an asset decreases on which side? On the credit side, because we are paying out. That's why this transaction will only affect asset. Asset will increase and also decrease by whatever amount that you've purchased that asset for. But if the fixed or tangible asset were purchased on credit, so you will record this transaction where? In your general journal. Remember, in the general journal, we record transactions that cannot be accommodated in any of the subsidiary journals that we've previously spoken about on our second lecture. Then what would you debit and what will you credit under a double entry system? So the asset will be debited because if you are buying that machinery, machineries will be increasing in the business. So you debit an asset, you are increasing asset. And what are you going to credit? You're going to credit your creditors control. That's a liability. Liabilities increase on which side? On the credit side. So as you are recording the purchase or the acquisition of property, plant and equipment in your accounting books, you also need to keep your fixed asset register up to date. So what we are saying here is that all relevant information relating to the purchase of each fixed or tangible asset must be entered into the fixed asset register. So all the PPE that you're going to buy, you're going to include them in your fixed asset register. So you need to have a register for tangible asset. So in this fixed asset register, the information that will be included, you will see the cost price. You will know exactly how much maybe your machinery cost, or the vehicle or the delivery van. It will be recorded where? In your fixed asset register. The date you have purchased that asset, it will also reflect on your fixed asset register. The supplier that you bought these fixed asset from will also be shown in the fixed asset register. The make or the model of that property, plant and equipment. If it's a motor vehicle, what type, what model, is it a whatever model that it is, you need to reflect on you need to record that on your fixed asset register. And then on your fixed asset, the information that will also go into your fixed asset register. It's a depreciation method. What method it's being used to depreciate that particular property, plant, and equipment. And the depreciation expense for each year will also be reflected in your fixed asset register. Your accumulated depreciation for each year will also be reflected in your fixed asset register together with your carrying value. So, and lastly here, what we are saying is that all fixed or tangible assets are recorded in the books at their original cost price. So which means here in your fixed asset register and even in your accounting books, you need to record these fixed tangible assets at their original cost price. Why are we doing that? Because we are following a historic cost principle. Under historic cost principle, we are saying fixed or tangible assets, they need to be kept at their original cost price. Yes, let me then move to the concept of depreciation. So what do we mean about depreciation? What is depreciation? So here, when we talk about depreciation, we are talking about a systematic allocation of depreciable amount of an asset over its useful life. So maybe just to simplify this, when you buy the property, plant, and equipment, for example, you buy a machinery, as you use that machinery, let's say, for example, you bought it for a machinery for 50,000 Rand, and the expectation is that you're going to use this machinery for the next 5 years, or the useful life of this machinery at 5 years. So for us, that as you are using this machinery, then the expectation is that the machinery will be losing a value each year over the next 5 years. If you bought it for 50,000 over 5 years, the expectation is that this machinery will lose a value of 10,000 Rand each and every year. That is what we call our depreciation. That's why we are saying here depreciation is a systematic allocation of the depreciable amount over the asset's useful life. So you will see that there's a term coming up which says depreciable amount. What is a depreciable amount? When you talk about depreciable amount, we're saying it's a cost price less the residual value. So if we're to define what is a residual value, then it is an estimated amount that an entity expects to receive when disposing the asset at the end of its useful life. So what we are trying to do here on the depreciable amount, we are depreciating the assets up to the cost that we cannot really recover, because the residual value is what we expect to receive when we dispose the asset at the end of its useful life. So now we know that the depreciation amount, it is calculated from the depreciable amount. How to calculate the depreciable amount? You say cost price less the residual value. Then what happens if the residual value is 0? So in this situation, we are saying we don't expect to receive anything from this asset at the end of its useful life. It will tell us that the depreciable amount will be equal to the cost price, because the residual value will be 0. If you say cost price less 0, you are still left with your cost price. What I also need to highlight here when we talk about depreciation, we said it is an expense for the business, because remember we said the asset or that machinery is losing the value as we keep on using that asset over its useful life. So depreciation is an expense. So we know that expenses increases on the debit side and they reduce on the credit side. What is also important here is that we need to make sure that the depreciation expense, it is calculated for each accounting period. But when do we start calculating the depreciation on property, plant, and equipment? From the date the asset it is available for use. So from the date it's available for use, that's when we start calculating depreciation, until the asset is fully depreciated over its useful life, or until it is disposed disposed. So that's when we start, and then we stop only when it is fully depreciated or when it is disposed. Disposed means it has been sold or we got rid of it. Then all depreciation expenses that you calculate for each accounting period are added together. When we add them together, we call that what? It is an accumulated depreciation. So now another new term is coming up here. What is an accumulated depreciation? So we are just trying to simplify here that all the depreciation expenses that you've been calculating for each accounting period, you add them together and they form what? It's an accumulated depreciation. So if you check the concept itself, it says accumulated depreciation. So it means all the depreciations that have been accumulated, they've been added together. So what is important here? Because I said our basic accounting equation, it's our basis of reasoning. So now we are trying to link to understand where is this accumulated depreciation gonna fit into. So what we are saying here is that accumulated depreciation is a contra asset account. So what do I mean by that? If you go to the basic accounting equation, we said asset increases on the debit side, they reduce on the credit side. But because accumulated depreciation is a contra asset account, it will mean that accumulated depreciation will increase on the credit side and reduces on the debit side. So it behaves the opposite way of an asset. This is very important because when you start doing your general ledger account, or when you start doing your journal entries, you need to know exactly what to debit and what to credit. Maybe before I move on, so let's say, for example, if we want to recognize the depreciation or record depreciation in that particular year. On our example, we said you bought a machinery for 50,000. Let's say you bought it at the beginning of the year, and then it's going to be depreciated over 5 years. So the depreciation will be 50,000 divided by 5, which is give us 10,000. How you're going to record this depreciation expense then into the accounting books of the entity? You're going to debit the depreciation. Because we said depreciation is an expense. Expenses increases on the debit side. You're debiting how much? 10,000. What are you going to credit? You're going to credit your accumulated depreciation, which is a contra asset account. When you are crediting accumulated depreciation, you are increasing the accumulated depreciation because we said accumulated depreciation increases on the credit side, reduces on the debit side. So what is also important here is that all the time when you deal with depreciation, you're also gonna need to affect your accumulated depreciation. So when you want to record or recognize depreciation, you debit the depreciation expense, you credit your accumulated depreciation. Then another, just to look into these other few important concepts when we're dealing with property, plant and equipment. So you will see that there will come to a point where, as we proceed with this lecture, where we need to determine the carrying amount of an asset. But what is a carrying amount? Remember, initially we said the measurement after initial recognition. We said we use for this module, we are using the cost model. Under a cost model, we said property, plant and equipment is carried at cost less accumulated depreciation and those impairments. So here we're saying how to calculate the carrying amount. You just say cost price less the accumulated depreciation. That's how you calculate your carrying amount of an asset. So when we start dealing with the disposal, the selling of a property, plant and equipment, you will see that there will be proceeds from a sale of an asset. So when you talk about a term proceeds from or earnings from a sale of an asset, we're talking about the amount to be received from a sale of an asset. So as we sell that asset, we can either make a profit or loss on sale of that asset. But how are you going to calculate to see whether there was a profit or on sale of that asset or not? So what we generally say, you will say your proceeds, you less your carrying amount. That is not correct what is written there. So you just say proceeds less your carrying amount, then you will see whether you've made a profit or a loss. So if what we are saying down here is that if proceeds are greater than your carrying amount, so we are saying the proceeds if you sell let's assume that you sell an asset for 15,000, that will be your proceeds, but your carrying amount was 10,000. So it means you have made a profit on sale of that asset. So what I want you to take away from here as we apply this concept is just, let's apply the logic. Proceeds up, you've sold an asset for 15,000 rand, but the carrying value that you have in the books is 10. So it means you've sold it more than its carrying value. It means you've made a profit. But if you sell that asset less than its carrying value, you are making what? A loss. And another term that will also come through, it's the asset realization account. So when you start disposing the property, plant and equipment, there is a temporal account that we use for that property, plant and equipment that we are selling, which is called, it's an asset realization account. The old term used to be, it's an asset disposal account. So we use this to close off the cost price and the accumulated depreciation of the asset that is being sold on the date of disposal. We also record the proceeds on the sale of an asset, and we also do what in this asset realization account, we determine the profit or loss on the sale of the asset. But don't worry about this concept that I'm just explaining here. I just want you to be aware of them for now until we start doing the question, where you will see how we apply these concepts then. So as I explained earlier, that we also need to look at the methods of calculating depreciation. So we have three methods that we use to depreciate the assets, the property, plant and equipment. The first one, we use what is called a straight line method, or it's a fixed installment method. I'll just explain this method first. I will also take you through the examples, how we actually do, how do we actually calculate that depreciation following these three methods. Remember that an entity will indicate, will tell you exactly which method they are following. So it's very important for you to stick to the method that is followed by that entity, because you can't use all these three at once for the same machinery. That you're going to use a straight line, you're going to use a diminishing, or you're going to use a unit of production. No. So just follow what the entity tells you. It's in terms of their accounting policy. They will indicate how they calculate depreciation for specific property, plant and equipment. So the first method that can be used is a straight line method, or it's a fixed installment method. So how do we calculate depreciation there? We say cost price less the residual value. I'm sure now you can see from that bracket, when we say cost price less residual value, we are talking about a depreciable amount multiplied by a depreciation rate. They might tell you that it is 25% per annum. So you will know that the depreciation rate is 25% or 20, 15, depending what type of an asset they have. Then you multiply that by months divided by 12. So the reason we are saying months divided by 12, there is a possibility that an asset can be purchased during the year. If the asset was purchased halfway through the year, you will multiply, you will say the months will be 6 out of 12, because you need to remember that the financial period or the accounting period is made up of 12 months. If the asset is purchased halfway through the year, it means it was purchased 6 out of, it will be with us for 6 months out of 12 months of that financial year. So that's how you calculate using a straight line method. It is very important, even when you do your activities, always show this kind of workings. How did you get there? Number two, another method that can be used, it is a diminishing balance method. It is also called a reducing balance method. So on this method, how we calculate the depreciation, we say cost price less that residual value and also less your accumulated depreciation. So we're saying cost price less residual value less the accumulated depreciation multiplied by the depreciation rate multiplied by months divided by 12. So if in this situation, if we are using diminishing balance method and we know that our residual value is 0, maybe we don't expect to receive anything at the end of the useful life of that particular asset, you will see that we will say cost price less 0 less whatever accumulated depreciation that we have. So which gives you the carrying amount. It's like you are taking the carrying amount multiplied by depreciation rate multiplied by months divided by 12. You will do this for, so you'll always update this as the accumulated depreciation keep on changing. Then you'll say cost price less with a new accumulated depreciation multiplied by the depreciation rate times months over divided by 12, because that is very important to always remember. So already we can see the difference between these two, that the other one we're using the carrying amount, the other one it's focusing on the cost price less residual value. So very important, the common mistake that we see from students, they mix these methods around. So you need to learn and understand these methods. And the last one that can be used, it's a unit of production method. So under the unit of production method, we calculate depreciation by doing what? By saying you take the actual units that have been produced during the year, you divide by the total expected units to be produced over its useful life, then you multiply by the cost price less the residual value. So under this method, let's say, for example, you bought a machinery and the expectation is that this machinery will produce about 2,000 or 3,000 maybe units. And then each and every year you expect maybe to produce 500. The actual production, then it's, if that actual production is 500, you will be saying 500 over 2,000 multiplied by the cost price less the residual value. Then you will get for that property, plant and equipment, what is its depreciation for that period. So before I move on from this slide, at least we know, we have an understanding how we calculate these, how we calculate depreciation using these different methods. Is that important thing that student always miss when you start dealing with depreciation? What I always prefer, number one, have a timeline. They will tell you when does the current financial period end. In this situation, the example that I'm making here, our current financial period ends when? On the 31st of May 20.1. So which means it started when? It will start on 1 June 20.0. So you go backward 12 times. So that, because we know that a financial period is made up of 12 months. So if it started on 1 June 20.0, it's going to be July, August, September, October, November, December, January, February, March, April, May. That is 12 months. So applying into this method, let's say, for example, if we are using a straight line method or diminishing balance method, if the asset was purchased, let's say maybe it was purchased on the 1st of January 20.1 on this table. So we know that it was with us for January, February, March, April, May. It was only with us for 5 months. To apply on a straight line method or diminishing balance method, you're going to say 5 divided by 12. 5 divided by 12, because it was available for use as from the 1st of January up to 31st May 20.1. So for me, I always say, good for you to get it right, have a timeline. Make sure it's 12 months and determine exactly when the asset was purchased and how long has the asset been with us, so that you calculate that particular depreciation, because not all assets will always be purchased at the beginning of the year. Some will be purchased during the year. You need to be able to prorata that depreciation expense. Now I want us to look into this particular exercise. This is exercise 11.1. You'll find it there in your study unit 11 for FAC 1502 students. So here they are saying, suppose Zamoguhle bought a machine on 1 June 20.0 for 500,000 with a discount of 60,000, transport cost 15,000, and installation cost at 5,000. Earlier, I explained how do we determine the cost price of property, plant and equipment. Machinery is forming part of your property, plant and equipment. We said they bought it for how much? For 500,000 with a discount of 60,000. We said trade discount. What do we do with trade discount? We deduct them. We deduct the trade discount so that they don't form part of the cost price. Then we add what? The transportation cost and the installation cost. Then we have here the cost price of how much? Of 460,000. So that's how you determine the cost price. So the estimated lifespan of a machinery is 5 years. So they expect to use this machinery for the next 5 years. And they're also telling you that the financial year ends, it's on 31st May. So which means it starts when on the 1st of June the previous year. We will now examine 3 methods using this information. So what is required out of you? Use the given information and prepare depreciation schedules, general journal entries, and the ledger account to record the depreciation of an asset according to the straight line method, diminishing balance method, and using the unit of production using the given additional information. So let me go back here. So we know now the cost price of this machine that was bought on 1 June 20.0. It's how much? It's 460,000. And we expect that it has a useful life of how many years? Of 5 years. So this you are required to prepare the depreciation schedules. So what I would like you to encourage you to do in this session is that just please listen here as I'm explaining how we made up this depreciation schedule, because you have it already in your learning unit. So I'm sure most of you, they don't know where are all these figures coming from. So allow me to explain that. So this is our depreciation schedule. We are using which method first? The straight line method. So under a straight line method, we set the cost price less the residual value. You multiply by the depreciation rate. You multiply by months, divide by 12. So what is important here? They told you that it was purchased on the 1st of June 20.0. So the first financial year will they told you that the financial year ends when? On the 31st of May. So if a year ends in May, 31st May, it means it started in 1 June the previous year. So they bought this asset at the beginning of the financial period. So that financial period, year 1, if I were to determine the financial period for year 1, it starts on 1 June 20.0, then it ends on 31st May 20.1. That's why here you will see that May 31, 20.1, and the cost price of an asset is how much? It's 460,000. On the next column, we are required to calculate depreciation. So we apply the formula that I showed you earlier. So we said that the cost price less the residual value. In this case, the residual value, we were not told, so we assume it is 0. So if you say 460,000 less 0, you'll be left with 460,000. And they told you that the useful life is 5 years. But on our explanation, we talk about the depreciation rate. So 5 years, if you were to take 100% divided by 5, it means it is 20%. The depreciation rate is 20% per annum. Or you can just divide by over 5 years and you multiply by 12 over 12. The reason you multiply by 12 over 12 is because this machinery was purchased at the beginning of the financial period. So which means the asset, this machine was with us for a full 12 months. So that's why they say 460 divided by 5. or you could have just said 460 multiplied by 20%, multiplied by 12 divided by 12. You will still get the same answer of annual depreciation of 92,000 rand. So if your annual depreciation is 92,000 rand on year one, that's end on 20.1, your accumulated depreciation, it will also be 92,000 rand. Why is that? We said for you to record a depreciation expense, you're going to debit what? The depreciation expense of 92,000 rand, because it's an expense, it increases on the debit side. And what are you going to credit? You're going to credit the accumulated depreciation. Accumulated depreciation, we said it's a contra asset account, which means it increases on the credit side, it reduces on the debit. So when you credit accumulated depreciation, you are increasing the accumulated depreciation by 92,000 rand. And on the last column here, where we're talking about the net carrying value. So how do you calculate the net carrying amount? We've already explained that concept earlier, is that we say the cost price less the accumulated depreciation. So if you say 460,000 less accumulated depreciation of 92,000, you will be left with 368,000. Let's move then to year two. Year two starts when? It starts on the 1st of June 20.1, and then it ends on 31st May 20.2. Because we are using what here? A straight line method. How do you calculate a depreciation under a straight line method? You will say 460,000 multiplied by 20. Or you could have just, instead of 20%, you could have just said 460,000 divided by 5, and then you multiply by 12 months divided by 12, because it was with us for the full year. You will see that the annual depreciation will remain the same as 92,000 rand. Then what happens then if we move to the next column for the year ending, for the financial year at 2? Under your accumulated depreciation, you will see now your accumulated depreciation is 184,000. When I explained earlier, I said all the depreciation that relate to each accounting period are added together, and they are called what? Accumulated depreciation. On year one, we calculated a depreciation of 92,000 rand. Then we included that's 92,000 rand as an accumulated depreciation. Then in year two, we calculate another annual depreciation of 92. Then you need to add on top of the 92 that's already there, because we are adding all the depreciation expenses for each period. So if you add 92,000 plus 92, you get 184,000. Again, you will have written the same journal. You will have debited the depreciation expense and credited your accumulated depreciation by 92,000. So if you add 92 plus 92, you get 184. What is also interesting here in year two, let's look at our net carrying amount. What happens to our net carrying amount? How do we calculate the carrying amount? You say cost price less the accumulated depreciation. So you go to year two, our cost price still remain the same as 460,000. You subtract your accumulated depreciation at the end of year two, which is how much? 184,000. Then your net carrying amount, it is 276,000. You will do the same even for year three. Year three, you follow the same calculation that we've been doing. You will also realize that this machinery was with the entity for the full 12 months. So which means the annual depreciation will remain as 92,000 rand. And what will happen to our accumulated depreciation? We already have 184,000 in our accumulated depreciation. So we need to add this 92,000 rand for year three, which then gives us an accumulated depreciation of 276,000. Then for us to calculate the net carrying amount at the end of year three, you will say cost price, which is 460,000, less the accumulated depreciation of 276,000. Then you get a net carrying amount of 184,000. We do the same even for year four. nothing changes. We still have our annual depreciation of 92,000 rand. Then for us to calculate our accumulated depreciation, you will have to say 276,000 that we already have on accumulated depreciation. You add the 92, then you get 368,000. Then to calculate your net carrying amount, you say 460,000 minus the accumulated depreciation of 368,000, then you get 92,000. At the end of year 5, you will see that even our accumulated depreciation is how much? It's 92,000 rand. And what is our accumulated depreciation at the end of year 5? You will see that you will take the 368,000 accumulated depreciation on at the end of year 4, you add the new annual depreciation of 92,000 rand, then you get your 460,000 rand. So what will be our net carrying amount at the end of year 5? If you say cost price less the accumulated depreciation, you have 0. As they have indicated to you that the useful life of this machinery is 5 years. So which means at the end of 5 years, there will be nothing left in its carrying amount. We'll have fully used that asset. That's why we have 0 here. So what I want to show you here, at the end of year 5, the total depreciation will have amounted to 460,000, and your accumulated is also how much? 460,000. So it's very important to know how to determine these amounts and how to calculate your annual depreciation and how to post this depreciation into your accumulated depreciation, and how to determine the net carrying amount at the end of each financial period. Remember, when we give you a question, we might give you a question to say, prepare maybe determine a depreciation and accumulated depreciation and the carrying amount for the year ending 20.4. So you will need to know how to get to 20.4 in terms of applying all these principles that I just showed you, that you will need to calculate each and every year until you get the correct figures for 20.4. So under this method, we are using a straight line method. You saw that the straight line method, we also call it a fixed installment. We've been depreciating 92,000 rand throughout. And what I want to emphasize here, our cost price. Cost price, we said, fixed asset or tangible asset are recorded in the books at their original cost price. We kept the cost price of this machinery as 460 throughout its useful life. We never reduced it because of the depreciation that we kept on recognizing. That's what we mean about the historic cost principle, that the cost prices should be kept as it is throughout the useful life of that asset. You can't come and keep on reducing this cost price because you are depreciating the asset. No, it doesn't work like that. All the depreciation, you will recognize them. You will include them in your accumulated depreciation. Because remember that for you to determine the carrying amount, you will say cost price less the accumulated. So it's effectively reducing that way. And here we are applying a cost model. So if we were also required here to do what? The journal entries. Remember here that depreciation is a year-end adjustment. We perform that adjustment at the end of the year. So we are saying the asset has been used for the whole year and it has lost a value of this much that we have calculated. So what you do when you are required to prepare the journal entries, but here you are required to do the journal entries for 5 years. So you go to the general journal. What are you going to do? You debit the depreciation expense. What do you credit? The accumulated depreciation. How much is it? 92,000. And then you credit that 92,000 because debit must always equal to the credit. You're going to do that journal entry for all these years, for year 1, year 2, year 3, year 4, year 5. The reason here they only showed this one, it's because that 92,000 is fixed for all those 5 years. So the journal entry will always be the same. You debit machinery, you credit accumulated depreciation for 92,000 and 92,000. And the narration that they wrote here is that the provision for depreciation under the straight line method for year 1, and for year 2, you will also write for year 2, year 3, year 4, year 5. And what I also want to highlight here, so if the second journal entry that they are doing here is that when you deal with income and expenses, they need to be closed off to your profit or loss account. So for you to be able to determine the profit or loss for the entity, you need to close off those accounts, those income and expenses account, because income and expenses account only operate for 12 months. You don't have balances carried over or balance brought down for expenses and income. So what we do here, then they're saying, because depreciation is an expense, so it needs to be closed off. To close it off, we are saying zero out that depreciation expense. So we said depreciation increases on the debit side. So we'll have that 92,000 on the debit side. So for us to zero out that depreciation expense, we need to credit that depreciation so that we have 92 on the debit and have 92 on the credit, so that we are not left with any balances there. So, but how do we do that? How do we do that closing off? We close it off to your profit or loss account. Someone might be struggling to say, how will I know which one to debit and which one to credit? What we are saying here is that depreciation is an expense. So expense increase on the debit side. So now when you are trying to reduce it or close it off to say, let's zero it out, you will need then to credit that depreciation expense on that machinery for 92,000, and what are you going to debit? It's your profit or loss account. That's how closing off of journal entries work. So you will do this the same journal end of 92 for year 1, year 2, year 3, year 4, year 5. Then you will also required to do what? To prepare the general ledger account for the machinery at cost. Remember that you bought the machinery for cash of how much? Of 460,000. Machinery is an asset account. So asset, when you buy it, machinery are increasing in your business. So we know asset increase on which side? On the debit side. So we need to debit that 460,000 on the machinery account. But what I want to highlight here, after the date, you wrote the date is 1 June. How much is it? It's 1 June. And then we write here bank. Why are we writing bank? Because we bought it for cash. So the journal entry that we wrote initially will have said debit machinery, which is an asset as it increases on the debit side, because machinery are increasing, we're buying it, it's coming inside. Then what are you crediting? You credited bank because you are losing money as you are paying for that machinery. So which means bank is an asset, it decreases on the credit side. So it's very important here. Student tends to confuse this here. So what we are saying here is that you are preparing a machinery account. So we are saying the machinery account was debited by what? It was debited by what was credited. What was credited was the bank. That's why you will write a description here and say it bank, how much? 460,000. That is very important. Number 2, if you check on you are also required to prepare what? Your accumulated depreciation on machinery. Remember that we've already, let me go back a bit. We are looking at column B here, accumulated depreciation. The first year we had 92, it grew 184, it went to 276, it went to 368 until it reached 460,000. So remember that we said accumulated depreciation, it's a contra asset account, it increases on the credit side and reduces on the debit side. So for year 1, the depreciation that we calculated for year 1, it was how much? 92,000. So the journal entry we wrote, we said debit depreciation, we credited the accumulated depreciation. That's why here you go to the accumulated depreciation account, you credit 92,000 and you write a description here. It was depreciation for year 1. Then we know that the debit must be equal to the credit. Both sides must be equal. So we have 92,000 rand now for year 1 on the credit. So we also need to have 92,000 on the debit side. So that 92,000 will be our balance carried down. So we are trying to balance both debit and credit. So the balance carried down that you see at 92,000 on the debit side, it becomes what? A balance brought down on the credit side on the first day of the financial year, the following financial year. That's why here it's written what? 1 June 20.2. It becomes the balance brought down of 92,000 rand. We also calculated what? We also calculated the depreciation for year 2, which was still how much? 92,000 rand. If you go back to our depreciation schedule, you will see that our accumulated depreciation was how much for year 2? It was 184,000, because we added the 92, which is our balance brought down from the previous year, plus the depreciation for year 2 of 92, you get 184,000. When you have 184,000 now, remember on the debit side, you did not have 184,000. So to balance both these sides, what you then need to do, you will say both sides must be equal to the highest. The highest is 184,000. So you also need 184,000 on the debit. Then that 184 is going to be what? Your balance carried down of 184,000. This balance carried down, if you check the date, it was for 31st May. So that's balance carried down. It becomes the balance brought down on the credit side at the beginning of the next financial period, which is 1 June 20.3. Because remember, this is an accumulated depreciation. Accumulated depreciation increase on the credit side, reduces on the debit side. So which means accumulated depreciation should always have a credit balance, which is our balance brought down of 182. We also need to take into account of the new depreciation for year 20.3, which was the same as 92,000 rand. If you add 184,000 rand plus 92, you get 76,000 rand. But what do you have on your debit side? You don't have anything. But we need to make sure that both these sides are equal. So we take the highest. The highest here is 276,000. You will also have 276,000 on your debit side. But here you will have a balance carried down, which is 276. That balance carried down, you post it on the credit side then at the beginning of the next financial period as what? As a balance brought down of 276,000. You will do the same each and every year until the asset is fully depreciated or disposed. Yes, fully depreciated or disposed. You will repeat the same until we get to 460,000, and then we have here 460,000 both sides. Then at the beginning of the next financial period, you will have that balance brought down of how much? Of 460,000. So that's how you do your accumulated depreciation account in the general ledger. I don't want you to get confused by the fact that you see a lot of amounts. As long as you first understand that accumulated depreciation increases on the credit side, reduces on the debit side. So when you are we've credited accumulated depreciation account because we have debited the depreciation. That's why you write depreciation here. You list the contra entry. So we've already explained this part of the depreciation on machinery. Depreciation of machinery, it's an expense. So you will have debited the depreciation expense. You credit what? Accumulated depreciation. So that's why here when you are debiting the depreciation account, you write what was credited. What was credited was the accumulated depreciation of how much? Of 92,000. And we close off this account. So we close off this account to where? To profit or loss, because we said the depreciation is an expense. Expenses at the end of the financial period, they need to be zeroed out. So you will notice that we credit what? That's depreciation. It is credited by what? By profit or loss account for how much? For 92,000. So here you don't see any balance brought down or any balance carried down, but because it's an expense, they need to be zeroed out. They need to be closed off to profit or loss account. But when you check your accumulated depreciation, it does have your balance carried down and your balance brought down. So these journals for depreciation, you will do it for all the years, year 1, year 2, year 3, year 4, year 5. So it will be the same. That's why here they just wrote 1. let's move now to say, so as I'll be showing you the second method. On this second method now, the first one that we looked here, there was a straight line method. Now we are using a diminishing balance method. We said under the diminishing balance method, we said the cost price less your residual value less your accumulated depreciation multiplied by the depreciation rate multiplied by months divided by 12. So this is what we are doing here. So we are still using the same scenario that we were given. We were told that the machinery was purchased on the 1st of June 20.0. So that was at the beginning of the year. And you were told that it was for how much? For 460. $160,000. And our depreciation rate, the useful life of this machinery is 5 years. So it's either you can use 5 years or you use a depreciation rate, which is how to calculate your depreciation rate. You will just say 100 divided by 5. That is 20% each and every year, which is our depreciation rate. What is key here as you calculate the depreciation is that we are saying cost price less residual value less accumulated depreciation. So we are calculating depreciation on the carrying amount. That is very important. We are calculating depreciation on the carrying amount when we follow the diminishing balance method or reducing balance method. So these are all layers. That's the same as the previous example. The cost price is still the same, 460. It does not change. We keep it as it is because we follow the historic cost principle, which requires us to keep the original cost price of the asset as it is. Then let's go to the third column where we are calculating the depreciation. Here they are saying 460,000. So on year one, I want to just emphasize this. On year one, what they're saying here is that if you say cost, because we are saying the formula says cost price less your residual value less your accumulated depreciation. So on year one here, we said the cost price is 460,000. What is our residual value? It is 0 because they were not told anything about the residual value. So it is, so we are saying 460 less 0 less the accumulated depreciation. On year one, what is our accumulated depreciation? It is 0 because we don't have anything. It is our first time starting to depreciate this asset. That's why you will say 460 minus 0 multiplied by 20% multiplied by 12 over 12. You get what? Your 92,000 rand. So if you can observe already, if you are using the fixed, the straight line method and the diminishing balance method on year one, the annual depreciation, it's the same. Then what is our accumulated depreciation? It's going to be 92,000. What is our carrying amount? At the end of year one, you will say how to calculate a carrying amount. You say cost of 460 less the accumulated depreciation. Don't make a mistake of minusing the depreciation. We are saying cost less accumulated depreciation. It gives you the carrying amount, the net carrying amount of 368,000. Let's see then on year number 2, how are we going to calculate our depreciation? We said under the diminishing balance method, we calculate the depreciation by saying what? Cost price less the residual value less the accumulated depreciation. So now it's year 2. So what is our cost price? It's 460,000 less our accumulated depreciation for the previous year, which is our 92,000 because our residual value is 0. So what are you going to get? You're going to get 368,000, which is our carrying amount. Then you multiply by 20%. Then you multiply by 12 over 12. Then you will get our annual depreciation of 73,600. Then what will be our accumulated depreciation? You will add 92,000 for last year plus the depreciation for current year of 73,600, you get 165,600. Then how are you going to calculate your net carrying amount at the end of year 2? You will say cost price less the accumulated depreciation of 165,600, then you get 294,400. Then if you move to year 3, so what I don't want you to get confused there here is that under the diminishing balance method, we are calculating the depreciation on the carrying amount. So again here, we are saying, so how do you calculate that? You know already for at the end of year 2, we had a net carrying amount of 294,400. You say that 294,400 multiplied by 20%, multiplied by 12, divided by 12, you're going to get 58,880, which is your depreciation. Then how do we calculate our accumulated depreciation at the end of year 3? You will say 165,600 accumulated depreciation of the previous year plus the current depreciation of 58,880, you get 224,480. Then at the end of year 3, how do you calculate your net carrying amount? You just say 460,000 less your accumulated depreciation of 224,480, you get your 235,520. You will do the same until you reach year 5. So it is very important to know how to calculate depreciation using these different methods. As long as you stick to the formula, you will be fine. Because that's what is important too, for you to know the formula, which one, how to calculate. And someone will be saying, but you said initially we calculate the depreciation using the diminishing balance method by saying cost price less residual value less accumulated depreciation, but here you are saying you're calculating it from the carrying amount. If you say cost price less residual value less your accumulated depreciation, in this case we're assuming that our residual value is 0. That will be equivalent to your carrying amount. So it's very important to know how to do this calculation. So you will notice that at the end of 5 years, the total depreciation is 309,267, and your total accumulated depreciation at the end of that year is 309,267. Just here, I'm just showing you what journal entries you will have processed for the next 5 years. I just selected for the first 3 years just to show you, because you will do it yourself. It will be the same, it's just repetition. On year 1, we said the depreciation was 92,000. So how are you going to record that? You debit the depreciation, then you credit what? Your accumulated depreciation of how much? Of 92,000. 92,000 in year 1. And you also do the closing off. On the closing off, you need to credit your depreciation expense, because when you're closing off the expense, you need to credit the expense and debit your profit or loss account by how much? 92,000 and 92,000. Year 2, remember on year 2, under the diminishing balance method, we found out that our depreciation was 73,600. So you will debit the depreciation expense and then you credit what? Your accumulated depreciation by how much? 73,600, 73,600. You also do the same closing off journal entry where you are crediting your depreciation by how much? By 73,600, and you are debiting your profit or loss by 73,600. You will do this over until the end of 5 years. It doesn't change. It's just the same, as long as you calculated your depreciation correctly and you are doing your closing off correctly. You will see as you continue studying on your learning unit number 11, as you practice, that's how you do it. You will get a better understanding. The more you practice, the better. again, this is under diminishing balance method. So we know how to prepare the machinery cost. So because you will have debited it by 460, and then you write the bank on the debit side, because when you debited the machinery, you credited the bank. Then if you move to accumulated depreciation, we know that our accumulated depreciation increases on the credit side and reduces on the debit side. So you will notice that on our, when we were using a straight line method, the depreciation were 92, 92, 92, 92 until the end of year 5. But here it's not. It starts with 92,000 rand. Then we also have another depreciation of 73,600. And then we have 58,880. We have 47,104. We have 37,683. So we still apply the same process as we have done for our straight line method. It's just that here we are seeing that the depreciation keep on changing. It keep on changing. It was not fixed or constant as we were doing for the straight line method. So you shouldn't be confused. It's still the same thing. It's just here we are showing you that we are using a diminishing balance method, and that's why the depreciation keeps on changing. And I've shown you how to determine this balance carried down and writing it as a balance brought down on the credit side at the beginning of the next financial period. So it's still the same thing. There's nothing that changed here. It's just that you need to sit down and practice it so that you know how it actually works. And then here, they are showing you the depreciation on machinery. Remember that the depreciation, it's an expense account. We said expenses, they are closed off at the end of each financial period. So remember, on our first example, we're using a straight line method, and there our depreciation was 92,000 throughout those 5 years. But here, it's different. So we need to show each and every year separately here. That's why you will see that depreciation is debited by 92,000 rand because we credited what? The accumulated depreciation, that the description you're going to write here. Then for year 1, you need to close off that 92,000 to where? To your profit or loss account. To close off the depreciation account, it means just credit it so that it's zeroed out. Both sides are balanced. Both sides are equal to 92,000 rand, so that you won't have any balance carried down or any balance brought down. The second year, you do the same. The depreciation for the second year was 73,600. Depreciation increase on the debit side. That's why we are debiting it, because you credited your accumulated depreciation. Then you close off this depreciation of machinery to where? To your profit or loss account of how much? 73,600. You will do this until you reach your year 5. So you keep on closing each and every year, keep on closing. You don't have to add 92 plus 73,600 because the depreciation account is an expense account. It does not retain balance brought down or balance carried down. It gets closed off to your profit or loss account, which means it gets zeroed out at the end of each financial period. Then the last method that we need to look into is the unit of production. You were told earlier that under the unit of production, we are writing off this machinery using the actual unit that have been produced over the expected unit to be produced for that particular machinery. So here they are telling you that production for year 1 was 500. Production for year 2 was 550, production for year 3 was 300, production for year 4 was 200, and for year 5 it was 450. Therefore, the total number of units expected to be produced by machinery equals to 2,000 units. So let's go and try to determine our depreciation in this situation. Nothing changed here. We're still working with those 5 years. The cost price is still the same. How then do you calculate your depreciation using the unit produced or the production volume method that they are talking about here? I see now my battery is so low. I think it will shut down anytime soon. But I will then request Dion to share for me once it shuts down, so that I will be able to continue with this lecture. For now, let me just continue until I encounter challenges. So here, what we are saying, calculation then of depreciation using the production volume method. For year one, you were told that there were 500 units that were actually produced. You divide the actual production over the expected units to be produced for the whole year, for the whole useful life of the machinery. You were told that there were 2,000. This is very important because students tend to confuse. They think that sometimes they will use the unit expected to be produced in that particular year. We are not working with that. We are saying the actual unit that have been produced, you divide by the total unit expected to be produced over the useful life of that asset. So here you say 500 divided by 2,000 multiplied by 400, 460,000. Then your annual depreciation will be 115,000. Your accumulated will also be 115,000. But how are you going to determine your net carrying amount? You're going to say 460,000 less 115,000. And then your net carrying amount, it should be 345,000. Sorry. Then let me, on year two, you were told, if we just go back a bit, in year two, you were told that there were 550 units that were actually produced. So you say 550 divided by 2,000, then you multiply by 460,000. You get your annual depreciation of 126,500. Then your accumulated depreciation, you would say 115,000 plus 126,500. Then you get your accumulated of 241,500. Then your net carrying amount will be how much? 218,500, because you're going to say the cost price less your accumulated depreciation. You will do the same until the end of year 5. I think we are quite familiar now with how we process this depreciation using these 3 different methods, and how do we calculate our accumulated and our net carrying amount. Then I won't repeat the same journals that you need to do. You know now how to do them and how to do your general ledger accounts. Then I want us to look into this important concept.
Good afternoon. It's Dion speaking. It seems that Sianda has currently run out of battery power. So what he told me is that for this specific presentation, the rest of the slides will be done as part of the recording. So when this recording is available, there will be another recording for the slides that he could not present. So you will find basically what he has presented up till now, and then the rest of the slides, which are basically for the disposal of assets, that will be in a different recording. So you don't have to attend another live event for the rest of the slides. The rest of the slides will be an extra recording that he will make when he has power again. But thank you very much for your attendance. And if you want to then watch this recording again, you can go back to the same link that you've used to join us today. The same link will allow you then to watch it again. And when this link together with the rest of the presentation will be available, you will see that the rest of the slides are regarding the disposal of the assets. So till the next presentation, enjoy your afternoon. Thank you very much and goodbye.